In this lecture, we will cover the CFA Level 2 reading on capital structure. This is a relatively short reading. The key focus of this reading is whether the capital structure of a company impacts value. We'll start with section 2, which deals with the fundamental capital structure decision. And what do we mean by this capital structure decision? It means what percentage of debt and what percentage of equity should we have in our capital structure. For simplicity, in this reading, we assume that our capital structure only consists of debt and equity. We are not talking about preferred stock, even though once you understand the concepts here, then we can easily extend our discussion to preferred stock, but that is not covered in this reading. I'm sure you're aware of this already, but just to make sure, the definition of capital structure, or when we talk about capital structure, we are referring to the mix of debt and equity. I would say that this reading is an extension of the cost of capital reading that you did at level 1. And the fundamental relationship that you learned in the cost of capital reading is how to come up with the weighted average cost of capital. If our capital is being raised through debt and equity, clearly there will be a different cost of debt and a different cost of equity. And weighted average cost of capital basically takes the average of the cost of debt, cost of equity, and weights based on the market value of debt and market value of equity. So at level 1, the relationship that you saw was that weighted average cost of capital is equal to cost of debt into weight of debt into 1 minus the tax rate plus actually cost of equity into weight of equity. Now, what you are seeing over here is instead of seeing weight of debt, we are simply taking D, which is the value of debt, the market value of debt, divided by V, which is the total value of the company. V is equal to debt plus equity. So this essentially is the WD that we talked about earlier. And then 1 minus T is the tax rate, E over V value, market value of equity divided by total value, and then cost of equity. And if you recall from level 1, all the rates that we talk about, the cost of capital or the cost of debt or cost of equity or the tax rate, these are all marginal rates. In other words, RD being marginal, or marginal rate means what's the cost of one additional unit of debt. In our discussion, whenever you see V, this refers to the total value of a firm, which is the market value of debt and market value of equity. And also, I hope you remember from level 1 that what we want to do is maximize the value of the firm. And it is a given that you maximize the value of the firm when the weighted average cost of capital is at a minimum. The question now becomes, what is the relationship between leverage and value? In other words, let's say you start with a company that's 100% equity and no leverage. Can you change the value, perhaps increase the value of the firm if you take on more debt? So that is the core question that we will address in this reading. And this reading has 7 sections that we will cover. Initially, we focus more on some theoretical views. So we'll focus on what Modigliani and Miller said, without taxes, with taxes, and so on. So section 2.1 deals with proposition 1 without taxes. This was a proposition put forward by 2 famous people, Modigliani and Miller. And they came up with a famous proposition called proposition 1, and initially this is without taxes. The proposition without taxes is the following, that the market value of a company is not affected by the capital structure of the company. So what they are saying is that given some assumptions, which are fairly restrictive and which I will share with you, it doesn't matter how much debt the company has taken. It doesn't matter in the sense that the amount of debt or the amount of leverage does not impact the overall value of the firm. So what are those assumptions? The first assumption is homogeneous expectations. In other words, all investors are expecting the same returns, the same standard deviation, the same correlations. Perfect capital markets, what this essentially means is that in capital markets, there are no transaction costs, there are no taxes, there are no bankruptcy costs. We can borrow and lend at the risk-free rate. And what this is saying is that in all cases, we as a company, when we borrow, our cost of debt is going to be the risk-free rate. If the risk-free rate is 5%, then we can borrow at 5%. And we can keep borrowing because there are no transaction costs, because there are no bankruptcy costs, etc. No matter how much we borrow, we can keep borrowing at this rate, at the risk-free rate. No agency costs. If you recall, in a corporate structure, there is an agency problem which refers to the fact that there is a conflict of interest between owners and managers. We'll talk about this later, but the simplistic assumption is that we don't have agency costs. Financing and operating decisions are independent. What this means is that the operating income that we generated is not impacted by any change in the capital structure. Effectively, what this proposition then says is that the value of a company is determined solely by the cash flows and not by the relative amount of debt or equity. And you will see this expression, VL is equal to VU, which is saying that the value of a levered firm is equal to the value of an unlevered firm. And the curriculum gives the example of a pie. Let's say that the total value of a company is depicted by a pie, and you say that initially 1/4 of this pie comes through debt and 3/4 comes through equity. So when we say the total value of the firm is equal to value of debt plus value of equity, obviously there are these two components. The question now is, if you change the situation so that you have debt 50% and equity 50%, does the size of the pie change? And according to proposition 1, it does not. If you completely remove debt and you have all equity, does the size of the pie change? The answer is no. In other words, no matter what the ratio of debt to equity, according to proposition 1, given these assumptions, the total value of the company is not impacted by the relative portion of debt and equity. Now, before I go to the next section, you might be wondering whether we are ignoring the fact that the cost of equity is higher than the cost of debt. If you recall, the overall cost of capital is equal to this expression. I'm removing the 1 minus t because here we are saying that there are no taxes. Also, we said that the value of a company is maximized when cost of capital, the weighted average cost of capital, is at a minimum. So if we are saying that the value is fixed regardless of capital structure, then we are also saying that the cost of capital is fixed or remains constant regardless of the capital structure. So does that really make sense? If you think about it, the cost of debt is going to be less than the cost of equity. The cost of debt is the risk-free rate, right? So let's say cost of debt is 5%. Does it make sense that the cost of equity is higher? The cost of equity should be higher. Let's say that the cost of equity is 10%. Now, if a firm has no debt, then what is the cost of capital? The overall weighted average cost of capital. Then the weighted average cost of capital should be 10%. So if we now start adding debt, what happens to the weight of debt over here? The weight of debt starts increasing, and the cost of debt is only 5%, which is half of the cost of equity. So you might think that if we are adding debt, which is lower cost, then that should bring the weighted average cost of capital down. But it's not bringing it down. Why? The reason is, as you add more debt, what happens to the risk of equity? The risk of equity actually increases. So Modigliani and Miller in Prop 1 are not saying that the cost of equity does not increase with more debt. So as we'll see on the next slide, the point is that the cost of equity is actually increasing because of more debt. More debt creates more risk for equity holders, and therefore the cost of equity is higher. And these two variables, the weightage of debt relative to equity and cost of equity, change in such a way that the overall cost of capital remains the same according to this proposition. So I'll just have you read this, and then on the next slide we'll go into more details on this and show you some equations. The relative risk or cost of debt and equity is not being ignored. Risk of equity is more than the risk of debt, but adding more debt increases the risk of equity. The increase in equity returns is exactly offset by increases in the risk and the associated increase in the required rate of return on equity, so that there is no change in the overall value of the company, or there is no change in the overall cost of capital. Now let's just go into this in a little more detail, and this actually leads us to proposition 2. According to proposition 2, the cost of equity is a linear function of the company's debt to equity ratio. So I'm just going to say this in other words, and then I'm going to run through over here. What we are saying is that cost of equity, which is generally denoted as RE, increases linearly as the debt to equity ratio increases. So let's work through this. I hope you remember this relationship. The cost of capital is the weight of debt into cost of debt plus weight of equity into cost of equity. Again, no taxes because we are ignoring taxes in this discussion. Then given V is equal to D plus E, the total value is value of debt plus value of equity. And let's also say that R0 is the cost of equity with zero debt. Right? So obviously when you start and if you say that there is no debt, then there is a certain cost of equity. We will say that that cost of equity is R0. Is that then the cost of capital, overall cost of capital? So R0 is equal to the weighted average cost of capital. So then if you use this relationship and instead of R WACC you put in R0, so R0 is equal to this, and you do a little bit of algebra, you will then end up with this relationship. The cost of equity is equal to R0 plus R0 minus RD into debt to equity ratio. I've done the algebra and this does indeed work out. So what is this now saying? This is saying that as long as the debt to equity increases, then what happens to cost of equity? This also is going to increase in a linear fashion. So that is what we are saying over here. As debt to equity rises, the cost of equity rises and the overall cost of capital remains the same. In other words, the cost of capital for a company, the overall cost of capital is determined by the business risk of a company, not by the capital structure. According to Prop 1 and Prop 2 without taxes, if you change the capital structure, that will not impact the overall cost of capital. It will only impact the cost of equity. So I want you to try this question now, and this has been taken from the curriculum. Do it before looking at the solution. So here is what you do. Before the debt-based restructuring, this is the value of the firm. It's EBIT, 5,000. We are taking this as a perpetuity divided by the cost of capital, gives us 50,000 as the value of the firm. So you can see 50,000 is the value of the firm, debt is 15,000, equity is 35,000. Then using the relationship that we came up with on the previous slide, cost of equity is R0 plus debt over equity into R0 minus RD. You plug in the numbers and you get cost of equity is equal to 12.14%. Now, what you can do is actually with these numbers, with this cost of equity and a cost of debt equal to 5%, you can actually show that the WACC is still 10%. And how can you do that? You can take 12.14 and multiply this by the weight of equity, which is 35 over 50, and multiply 5% by the weight of debt, which is 15 over 50, and you will actually get 10% as your WACC. If you want, you can also look at the working in the curriculum where they also prove that the value of the company remains 50,000 even after this transaction. Now we move to section 2.3 where we introduce taxes. With corporate taxes, value increases as we take on debt. We are still going to ignore financial distress and bankruptcy. But what is the relationship now and why does this happen? The reason value increases when we take on debt is that interest payments are tax deductible. So this is a basic premise that when a company makes dividend payments, then the dividend payments are not tax deductible. But when a company makes interest payments, then the interest payments are tax deductible. So all else equal, the value of a company with leverage is going to be more than a value of a company without leverage. So let's go back to the relationships we saw before. Now we are saying that the value of a levered company is equal to a value of an unlevered company plus TD. TD is essentially the tax benefit. T is the tax rate and D is the amount of debt. Now the cost of capital is given by this relationship, which should look very familiar. This is what we have seen at level 1. And using the sort of algebra that we've seen before, we can now show that the cost of equity is given by this relationship. And I want you to remember this. Cost of equity is equal to R0 into R0 minus RD into 1 minus T times debt over equity. How is this different from the previous expression? The only difference is the 1 minus T. So when taxes are introduced, then you throw in the 1 minus T. Now I want you to try this. Same company, but we are assuming a tax rate of 25%. Calculate the value of the company before debt is issued and then the value of the company after debt is issued. So here is what you do. On the left, we have calculated the value of the unlevered firm. So this is before any debt has been issued. We look at the total EBIT, remove the tax, and if you plug in the numbers, you will get a value of 37,500. Once debt has been issued, we have a levered company. The value of a levered company is equal to the value of the unlevered company plus tax rate into debt. You plug in the numbers and you will get value of levered company equal to 41,250. This is the core point. If you want more details, then you can continue with this example in the curriculum. So here is a summary of what we've been talking about, and this slide is critical because if you get a case study on this reading, then I'm sure that there'll be at least a few questions related to what you are looking at right now. Prop 1 and Prop 2 without taxes. Without taxes, we say that the value of a levered firm is equal to the value of an unlevered firm. In other words, you cannot change the value of a company simply by changing the capital structure. And then Proposition 2 without taxes is simply saying that cost of equity increases linearly as the debt to equity ratio increases. Then if we introduce taxes, then Prop 1 says that the value of a levered firm is equal to the value of an unlevered firm plus T times D, and this is what the cost of equity becomes. It's like the expression before, except that we introduce 1 minus T. And these graphs at the bottom depict what we have been talking about. The line at the bottom over here, this is the cost of debt. In our example, we've taken cost of debt is 5%. This dotted line over here is the weighted average cost of capital. So this is the WACC. Notice that if debt is 0, then cost of equity of 10% from our example is equal to weighted average cost of capital. This line over here is the cost of equity. The x-axis is the debt to equity ratio and the y-axis is the overall cost of capital, or this is essentially the rate. So as debt to equity increases, the cost of equity is increasing linearly. In a world with taxes, look at what is happening to the weighted average cost of capital. As we take on more debt, so debt to equity is increasing as we move to the right on the horizontal axis. What happens to weighted average cost of capital? It is going down. So what happens to the value of a company according to these relationships if we keep increasing debt? So in this theoretical world, it makes sense to keep on taking more debt. As you keep on taking more debt, then WACC will keep coming down and the value of the firm will keep going up. But remember, this is a very theoretical scenario where there are no bankruptcy costs. Now we'll go through a few simple examples from the curriculum, and these can be done using your basic level 1 knowledge. So this is what you do. 8% before tax into 1 minus t gives you 5.28%. Very straightforward. Here is the working from the curriculum also. Next one, try this. So here is what you do without taxes. Just reproduce the relationship that we've talked about, plug in the numbers, and you should get 15%. In a world with taxes, all we do is plug in a 1 minus t over here, and you are given the tax rate is 32%.
10.2%.
So when you plug in the numbers, in the second case, you should actually get 14.36%. Section 2.4, the cost of financial distress. So now we are extending our discussion and recognizing the fact that there is a cost of financial distress. The downside of operating and financial leverage, if you recall from level 1, high operating leverage means that you have high fixed costs, lot of capital. Financial leverage means that you have taken on high debt. So what is the downside of high leverage? It is that earnings are magnified downward during economic slowdown. So when your EBIT is low and you have fixed costs, be they fixed operating costs or fixed financial costs, then that has a negative impact on your overall income. So this can put a company under stress, and that stress, when a company has trouble paying, for example, EBIT is low and the cost of debt is high, the company obviously will have trouble paying its debtors, and then we say that a company is in financial distress. When a company heads towards financial distress, and when a company gets to financial distress, there are costs associated with that. So what are those costs? We can think of two broad components, 1 and 2. The first one is the cost of financial distress and bankruptcy in the event that they actually do happen. So if bankruptcy does happen or financial distress does happen, then we have some direct costs and some indirect costs. What are the direct costs? These are the actual cash expenses associated with the bankruptcy process, such as legal and administrative fees. So that's an obvious cost. The other is that if a company is facing bankruptcy, it will not be able to make new investments. Customers will not want to do business with this entity. Suppliers will shy away. So there will be all these indirect or implicit costs. The other scenario is where a company is not bankrupt yet or is not in financial distress yet, but the situation is such that the probability of bankruptcy is increasing. For example, let's say that the company has taken on a lot of debt and it appears that the economy is going to move towards a recession. What does that do to the probability of bankruptcy? That probability increases. Do you think that higher probability impacts the company? The answer is yes, because if you just think about it, what will happen then to the cost of borrowing? It will go up. Customers will be concerned about the viability of this company, so they might also hesitate placing orders. So let us read formally what the curriculum says. The probability of bankruptcy increases as the degree of leverage increases. That is a given. The probability of bankruptcy depends in part on the company's business risk. So if the company's business risk is high, which means that the variability of sales and the variability of expenses is high, then that also contributes to the probability of bankruptcy. Other factors that affect the likelihood of bankruptcy include the company's corporate governance structure and the management of the company. So if the corporate governance structure is weak or the management is weak, the controls are not very strong, then obviously that also increases the likelihood of bankruptcy. Here is something that you can pause the video and listen to. It is costs of financial distress related to Enron. For some reason, the curriculum loves to talk about Enron. You might recall Enron from level 1 FRA, and here again they are talking about Enron. So fairly straightforward. It is material that we've just talked about. Next, we cover agency costs. Agency costs are the costs associated with the fact that all public companies and large private companies are managed by non-owners. Agency costs are the incremental costs arising from conflicts of interest when an agent, so this is the management team, makes decisions for a principal. Principal is the owner or the shareholder. So what goes on over here? You need to understand the specific agency costs, and I hope you remember this from level 1. The key point here is that ideally management should work towards maximizing the value of the firm. That is what the owners want, but what management might want is higher salaries, more perks, etc. So at times management might not operate in the best interest of shareholders. The costs associated with that are called agency costs. Now specifically, if we drill into agency costs, there are 3 components. Monitoring costs borne by owners. Now, if I'm the owner of a company or I am the shareholder, then obviously I'll incur some cost in terms of putting in processes, procedures to make sure that my management is working properly. For example, the time that I take out to go to my board meetings is a cost. So that is a monitoring cost. Another cost is the bonding cost borne by management to assure owners that they are maximizing company value. A very simple example is, do you think management has to put in a lot of effort into status reports and other reports to show owners that they are doing a good job? Answer is yes. Are those reports in of themselves adding value or increasing cash flows? No, but this is a cost that needs to be borne, and that also is an agency cost. If despite 1 and 2, there is still a loss in value, then that is called the residual loss. This is the loss even when there is sufficient monitoring and bonding. An obvious remark, but I'll make it regardless. This is an obvious remark. A better a company is governed, so the stronger the corporate governance and the corporate governance structure, the lower the agency costs. The final point for the slide is something called the free cash flow hypothesis. High debt levels discipline managers by forcing them to make fixed debt service payments and by reducing a company's free cash flow. Now, this is a hypothesis, it's a view. Some people argue that, look, one way to keep management from spending money on projects that they should not be spending money on is by taking on a lot of debt. Because when there is debt, then management will spend money carefully and not put money on projects which have maybe negative NPV. Now here, I read somewhere an interesting analogy that I'll share with you. So the analogy is this: management is like someone who is driving a car. Okay, so let's say that this is the manager, the CEO, this is the steering wheel. And the level of debt is like a knife which is pointing out from the steering wheel. Okay, so the more the debt, the greater this knife. So what will management do when they know that there is this knife over here? Will they drive the car more carefully? Obviously, they will drive the car more carefully. But what is the risk? The risk here is that no matter how carefully this manager is driving the car or running the company, if there is a major downturn in the economy and he needs to brake suddenly or make some other evasive action, then there will be trouble. There might be some blood, right? So this free cash flow hypothesis has its positives and negatives. The positive is it forces the manager to manage the company carefully. The negative is that there might be circumstances that are outside his control where he suffers, right? So that's the free cash flow hypothesis. What are the costs of asymmetric information? So understand this basic point. Managers have more information about a company's performance and prospects than the outsiders, equity holders and other investors. So this is called asymmetric information, where the insiders obviously know more than the outsiders. Investors demand higher returns when asymmetry of information is high because this increases the probability of agency costs. If a company hides what it is doing, doesn't make sufficient disclosures, then the outside world will assume the worst. And when contributing any capital, the outside investors will demand a high return. What outside investors tend to do is watch what the managers or the insiders are doing. The actions taken by the insiders speak much more or say a lot more about the company relative to what the managers just say. So the point here is that based on this, it becomes relatively difficult for managers to raise money through equity. Why is that? If there is a given project, let's say project P, and I'm the manager and you are an external shareholder. Let's say that I know that this project P is very risky. The probability of failure is high. If it is successful, then we can make a lot of money. So with a project like this, am I more likely to go for debt financing, I being the manager? Am I more likely to go for debt financing or equity financing? I am more likely to go for equity financing because there is a big risk of the project not doing well. On the other hand, if I have project A, where I know that this project is going to do really well, the probability of success is extremely high, I know that this will make a ton of money, then am I more likely to go for equity financing or debt financing? Then I'm more likely to go for debt financing. So the sort of financing that I seek tells the outside investor a little bit about the project, or perhaps more than a little bit. So that means that the outside world is looking at what I, the manager, am doing and trying to figure out what's happening inside the company. So that means anytime I try to raise equity financing, the outside world will look concerned. So they will then, the outside world will demand a high return when they contribute equity capital. So my cost of equity is going to be relatively high. So there is this theory called the pecking order theory, which deals with a situation like this. Since the actions of managers send out these signals, what managers try to do first typically is use the company's own money. And that also has then no flotation cost. So when a company wants money for new projects, the first preference will be on internal financing or using retained earnings. Then the second preference will be debt financing. Why? Because the cost of debt financing will be relatively cheaper, plus debt financing also sends a better signal than equity financing. And then often the last resort is equity financing. And I hope you got this message and you understood why debt financing sends a better signal. Since the outside world is looking for our actions, when we raise money through debt, then we are telling the outside world that we are pretty confident in the cash flow that will be generated from this project. The optimal capital structure according to the static trade-off theory. So now we are moving away from the very theoretical world of Modigliani and Miller, and we are recognizing the fact that there are costs of financial distress. So this picture, which is not as complicated as it looks, is going to explain what is called the static trade-off theory. I'll just show you a basic relationship and then connect it with the picture that we are looking at. This part of the relationship, the value of a levered firm is equal to value of an unlevered firm plus tax rate into debt. This we've already talked about. But now in the real world, clearly there is some cost associated with financial distress. We've just talked about that, right? The moment you are heading towards financial distress, there will be customers who don't want to do business with you and so on. So will that reduce the value of a firm? It will. By how much? We are not going to get into the exact number, but we know that there is some present value associated with the cost of financial distress. That present value is the amount by which the value of the firm comes down. So now, according to the static trade-off theory, this is the value of the firm. It is the value of a levered firm is equal to value of an unlevered firm plus TD, which gives us the tax benefit associated with debt, minus the present value of the cost associated with financial distress. So now let's look at the graph. On the x-axis, we have the debt to equity ratio. Does the risk of financial distress, this risk, does this increase as we move to the right? Yes. So obviously this risk is minimal when debt to equity is 0, and the risk of financial distress increases as we move to the right. So what does this point represent? And what do the various lines represent? This is the value of the unlevered firm, right? So on the y-axis we have value. So this is the value of the unlevered firm. Given a world where we have taxes, and given a world where interest payments are tax deductible, what will happen as the debt to equity ratio increases? What will happen to the value of a firm? This dotted line over here represents the value of a firm in a world where we do not have a cost of financial distress. So value goes up as we take on more debt because interest payments are tax deductible. So this line over here represents the value of a firm where we do not have financial distress. So what is this distance? At any value of debt to equity, this distance is the present value of the interest tax shield, the fact that you get a tax deduction by paying interest. So that is the value of the tax shield. But then this other curved line over here, what is this? This is the actual value of the levered firm, which does take into account the present value of costs of financial distress. So the distance between these two, the dotted curve above and this solid curve over here, this distance is the present value of costs of financial distress. And the optimal capital structure is that debt to equity ratio where the value of the firm is maximized. So this is probably the most realistic theory because it takes into account taxes, it takes into account the fact that interest payments are tax deductible, and it takes into account the cost of financial distress. Now, how does this connect with the weighted average cost of capital? The picture in the top part of the screen is what you've just seen. At the optimal capital structure where the value of the firm is maximum, that is where the weighted average cost of capital is going to be the minimum, right? So that is the critical point over here. This is something that you can read later, but I'll summarize the point. This excerpt has been taken from the curriculum. When you are analyzing a company and you are considering the capital structure, what you should generally consider is the optimal capital structure, which is also sometimes referred to as the target capital structure. The target capital structure is the structure at which the company's value will be maximized. But companies do not always operate at that optimal capital structure or the target capital structure for several reasons. One major reason is that it's not always easy to just raise debt or raise equity, so there are costs associated with doing that. There might also be situations where the market conditions are such that it is not currently feasible to raise debt or issue equity. So you can read this excerpt, it is fairly straightforward. Now I want you to quickly try this. Example 4, financial leverage and the cost of capital. So this is a fairly straightforward question. Here is what you should get. All we are doing is we are given different levels of debt and equity. We know the cost of debt, we know the cost of equity. So you use your level 1 knowledge. You come up with the weighted average cost of capital at different levels of debt. And given the numbers, the optimal scenario is to take 50% debt, because at 50% debt, our weighted average cost of capital is the lowest, which means that the value of the firm is maximum when we have 50% debt. Or I should say that relative to these, given these three scenarios, the maximum value is with 50% debt.